Thanks for joining us, everyone. Much appreciated. Jake will be coming on in a second. I want to just share my screen and go all over the disclaimer. Neither Jake nor myself, Market Chameleon, are broker dealers. We're not giving professional advice. We're just going around with our ideas and hopefully showing you something about Market Chameleon and picking the doctor's brain. So take a quick look at the disclaimer. And with that, all the way from Senegal, Africa, the doctor, Jake Kilby. How you doing, doctor?
I'm really good, thanks, Will. And it's great to be back after what has been it's been a great 2021, but a tumultuous start of 2022, right? So, yeah, greetings to everybody from Dakar, Senegal, which is the capital of Senegal. I'm out here for the next 7 weeks, then back into Malaysia. So hanging out in West Africa at the moment, and yeah, enjoying it. I've put some adventurous photos on the Discord for people who want to see something a bit different, and yeah. So let's
for those who don't know, Jake is probably one of the first people to use the Chameleon. One of the first people we had on the premium service, has been a longtime user. He has started a Discord group, and another active Chameleon on that group, Raj, does a monthly webinar as well. They've put a lot of time and effort into it. Recommend anyone who is listening to this show and has not tried the Discord. It's a service that anyone can use. So I'll put a link to that. Thanks for mentioning it, Doctor. I should have mentioned that at the beginning. I'll put a link to that in the chat, and I will also put it on. We're simultaneously broadcasting on YouTube. It's amazing we can do that and have someone in Washington's Cross in Pennsylvania, where I'm from, and another in, and I'm going to mispronounce this, Dakar, is it? Senegal?
Yeah, Dakar, Senegal. Yeah, I'm on the other side of the Atlantic, furthest point west.
So what time is it there? Like 9 in the evening?
It's about like 8 p.m. in the evening. Yeah, I think we're going out to the close, right? So my close is generally between 6. Well, I'm working now actually on Interactive Brokers on the Chameleon platform about 6 p.m. to 9 p.m. every night. Completely different from my time in Malaysia when I was getting up at 10 p.m. and working all the way through the morning. So a bit different, but yeah, cool nonetheless. So look, and also for the Discord guys, apologies. I haven't been as active as I'd have liked to have been. Pretty busy actually, traveling around and so forth. But I generally do try and put some posts on Sunday, do a bit of research and stuff. And then when people give me a few questions or private messages, I tend to reply to them as well. So anyway, let's just get started today. And we're going to start with the basics. If I can get my computer working, stand by. Everything's a bit choppy here. We're going to go with a long call. So, we've already gone through the Greeks, and they're really the foundational building blocks to understanding how options work. And from there, we're just going to go into the basics: long calls, short calls, long puts and short puts, before getting into probably some more detailed stuff. And here I've posted a few images just for you to give you guys a feel for what it's like in West Africa. So doing some work actually in a gold mine of all places. And I've got a little picture there of the accommodation block with a monkey up there on the right-hand side, which was my regular neighbor for about a good part of a week. And then you've got even me in the background. You've got a bit of a shot of the gold mine. I actually made about a 500-mile drive today. I got up at 6 o'clock in the morning and just made it back. And I took photos as well for you guys, particularly the guys in the States who haven't seen, goats on the backs of trucks and stuff like that. We've got a goat in Texas, but we've even got them in trucks.
Yeah, I was just going to say the only goat I've seen is from actually our goat. He's an active chameleon and a trader he's on the Discord quite a bit, and an all-around interesting character, Argo.
Yeah. So I haven't seen goat for a while, but the only one I've seen is on the back of a truck. So look, very basically, this 2x2, and I've spoken to you guys about this in the past. When I started off trading derivatives as long as I've been on the Chameleon, about 4+ years ago now, and actively managing a book of risky assets. So this is the first thing I kind of, cut out and put in the back of my pocket to understand. Now, apologies for all the experts and stuff, but this is where you really start. And today, what we're going to speak specifically about is the, directional long call side here. So the right to buy an underlying at a given strike price at a given expiry. It has the advantage of unlimited gains, limited losses. pretty standard stuff, right? So when we take on a long call, we're taking on directional risk, so positive delta. We have time decay working against us, so theta is negative. We're taking on gamma risk, and also volatility is positive for long calls. So when I'm actually looking at choosing options, and this is what I do specifically with the unusual options activity report on the Market Chameleon, I'll often scan for unusual options. And one of the things I'm looking for is options which are building up in volatility, but presently have low volatility. So what I'm getting at by that is, buying long calls with mega high volatility, generally, at least through my experience, has generally ended in in failure. Because volatility at some stage or rather will compress. So ideally, what you're looking for is call options with a lower volatility and building into it. And for the other, I've put on this rubric here, long puts, short puts, and short calls.
Hey, Doctor, just so you know, I don't know if I just noticed you're not sharing a screen. If you were trying to share a screen, we're not shared.
My goodness. Okay, stand by.
So that's being the case. I guess those pictures we were supposed to all see, and I didn't see them. I don't know if anyone else did, but on my screen, they weren't popping up.
Okay, share screen. Can you see this, guys?
Oh, yeah. Now we can see it. There you go.
Okay. So really apologies for that.
So they're the goats on the back of the Toyota.
Yeah. I'm gonna dive ahead, but you guys can see some of those. Posted a fair few on the Chit Chat channel on the Discord as well. Just trying to
everyone go to that link I put out there and get on the Discord. You can see all these photos. Pretty cool.
There we go. And so let me just keep going through. So like I said, long calls is what I'm going to speak about today. The right to buy an underlying at a given strike and given expiry date, unlimited gains, limited losses. And as I mentioned before, and we've seen this during the Greek series, we're taking on directional risk. So we've got positive delta. Time goes against us, so we have negative theta. We're taking on gamma risk as well. I won't speak too much about rho because it's marginal really in the current macro environment. But vega or volatility is also something which is positive for long calls. And what I was mentioning earlier is when I'm looking at the outstanding options report, I'm often looking for positions or underlyings which have low volatility but growing volatility and is backed by volume in terms of people buying into the options and so forth. So I'm going to skip ahead because I'm a bit behind, but here we go. So really simplistically, long, buying a call option, it's a bullish position if you take it on its own. If you add it to something else such as a short equity position, you can turn it into a synthetic put. Had limited losses and unlimited gains, as I mentioned. Positive directional risk. Remember, we spoke about delta, which is directional risk. So, something at the money is 50 deltas or an option. It really describes the at which an option's value will change in regards to a movement in the underlying, right? So if you have 50 delta at the money, which is a lot, which is where we find the volume often in options trading. Well, if the underlying moves $1, your option will move about 50 cents. We have positive vega, and as I described earlier, we mentioned that I often hunt for options positions or underlyings which have growing volume or growing open interest, stuff like that, and also volatility which is low but growing and or developing, something that I post often in Discord. Really basic stuff. So I've put the payoff diagram here and just basically calculating a break even, right? So strike price plus the cost of the call is your break even. So if this is a $20 strike and you've paid $1.50 for the call, your break even where your under or your option will start making money is at $21.50. Now, one of the things I've got for the more I would say experienced guys is what does this payoff diagram look like? You can combine two things to get the same thing. And just to give you the answer, it is a long position in the stock and a long put. So if I drew, sorry, my drawings are terrible, but it doesn't matter, I haven't got my magic marker. But this is essentially what a long position in the stock would be. If we took a long put, right, a protective put per se, we would be covered here and then beyond a point that would develop. So as you can see, this bit here and this bit here negate themselves. And that's why you've got that baseline there. So essentially a long call is a position in the stock or a position in a stock with a long put, what we call a protective put. So what I'm trying to get at there is you can use options and or other financial instruments to develop synthetic positions or to replicate positions. Yeah, and we've gone over this already, but it's something I wanted to just remind everybody, people who haven't seen the Greek series, and maybe go over the time decay part. Time decay is pretty important for long call positions. So the key thing here is to really look at buying more than is required. And the reason is because time decay moves slowly further out into the future, but as we get to expiry, it starts to rapidly accelerate. And I mentioned this. So we take a position here 90 days out, we'd have slow time decay, that would eventually pick up, and then we'd have like that negative 4G drive. So when we want to, or at least myself, when I'm buying options, you want to buy more time than is required. So for example, if you have an outlook on a position and you believe that this position will move in 90 days, then ideally what you want to do is not buy an option at 90 days to expiry, but something at 120 days and then sell the remaining time because of this time decay. And here, you really want to be a buyer of long calls or long options further out into time. And if you want to sell options, it's something for another episode, but you would want to do that with, short time to expiry, because this is where you're benefiting from all that theta decay. See here, we have very big decay very quickly within I would say, the last 2 weeks until expiry. So pretty important to think of, because when you're taking out a long call, you are exposing yourself to negative time decay or negative theta. So each day that option will lose value. That time works against you, as opposed to being short calls where that time will work for you. Okay, so one of the things I put here, again, the options value is its extrinsic value. So that's related to the underlying, its intrinsic value related to the underlying, and its extrinsic value, which is generally related. We often use the terminology time value, right? Now, this is important because, and it's not exact what I'm saying here, but essentially if you take an at the money call option, it provides you about 50% intrinsic value, and the rest is essentially time value. If you buy something which is deep out of the money, you're essentially buying time value. And what you find is you have less directional risk, because you are, you've got maybe a 0.5 or a 0.05 delta exposure. You've got less directional risk, less probability of that option being auto-executed or you actually calling the option. So very much different. And one of the strategies you can think of doing often as traders, particularly as the newbies, whenever they buy an option, they'll just buy at the money, which makes sense really, because often that's where the liquidity is. So it's easy to get filled, etc. And even myself, I was kind of like trained always to buy at the money. When you actually develop an option position, what you want to be looking for is you want to be looking at the options chain and making that selection in regards to what you want to achieve, right? So how much directional risk you want to take on. If you want to take on a lot of directional risk, you're going to go deep into the money. How much, theta risk or time decay risk per se do you want to take on? And so if you wanted to take on all time decay risk, you go deep out of the money for other reasons. One of the things that I've found is, particularly on short options or short dated options, buying deep in the money calls allows you to minimize that risk exposure to time decay, because you're taking on so much intrinsic value. Bit of a tongue twister there for me. So if you're buying a call option at the 95 delta, right? So the equivalent of 95 stock or 95 stock in the shares in the underlying, should I say, then you're limiting, at least to some extent, the time decay you have related to that. So that one there, pretty important, just a key rule along with that 2x2 chart that I put out earlier. Sorry, my little magic pen's not working tonight. But option value, just think intrinsic value related to how the underlying moves, and then add that to extrinsic value, which is, time value in general, right? So time decay. Now here I've put up, and I'm gonna switch over to the Market Chameleon a bit just to show you guys some stuff that I go through regularly when I'm looking at long calls. But I've just taken a snapshot of the options chain. This is a SPY, so the S&P 500 Spider, one you guys are all very familiar with, one of the most liquid ETFs that is out there. And I've essentially just taken the call side just to go through some stuff with you. So in terms of risk exposure, deeper in the money calls increases your directional risk, right? So when we're up here, when we're buying deep in the money calls at, maybe the 80 delta or 90 delta, then we're exposing ourselves to significant directional risk. But in hand, what we're limiting, at least to some extent, is that extrinsic value, or that time value or time decay risk. So by increasing the proportional, I've written it here, the proportional representation of the option's intrinsic value, you reduce its extrinsic value. And that helps to a certain extent lower time decay, particularly on short dated options. So what I do personally, when I use the long call, I'm more of a buyer deep out into the future per se, and buying more time than required. And if I'm using short options to actively manage a position, then going deep in the money, even though it's more expensive in terms of outlay, is something that I'll do to try and limit my time decay, which is particularly a part of, when you're managing short dated options, this is a particular time where theta decay is at its most meaningful. So using deep, as I've written here, using deep in the money short dated options is another way of, I wouldn't say avoiding time decay, because you can't avoid the passage of time, but you can definitely limit it by loading up on extrinsic value. It costs more, obviously, but it also helps you limit that part. So if you look at this options chain around here, so we're deep in the money here on the calls. I'm on the call side. We have more directional risk, right? So if I take an 80 delta option or a call option in SPY, then when SPY moves for $1, the value of my option is going to move for 80 cents. I have higher probability of that option being, not assigned because I'm long, but I have a higher probability of me calling that option or auto executing, as you'd see on the Interactive Brokers platform, and I have less exposure to time decay per se. On the flip side, over here, so out of the money calls are essentially pretty much made up of time value. And that's why, and this is on this side of the options chain, when you're buying a 5 delta or a 10 delta call option, you're essentially just buying time because when the underlying moves, $1, for example, on the SPY, then the value of your option is only going to move 10 cents, right? So it doesn't move very, very often. And I remember when I started trading options, I actually naively thought, oh, well, I'll buy the out of the money options because they're cheaper. It made no sense whatsoever. But what I'm trying to get at here is that when you look at an options chain, where you position your call option will determine what you're taking on in terms of risk exposure. And these are the things to think about. When you buy an option, you need to think about risk, and you need to think about all the other things we mentioned in terms of the Greeks, etc. So down here, or up here, should I say, this is at the money. These are out of the money call options. This is a $439 strike down here on SPY. You've got less directional risk, meaning that if SPY moves up, then your option's not going to gain much value. You've got a lower probability of that call option, of you calling that call option away, because remember, you're long. And you have more theta, you're more openly exposed to time decay. So a couple of things here before we dive into the Chameleon on active management. Just a few things on how I manage the position. So I've got two scenarios here. You buy a call and the underlying heads south, or the underlying goes to the moon, right? With the underlying heading south, there's a few things you can do. Depending on your view of the underlying, right? If you buy a call option, by default, you have a bullish outlook on the underlying. However, if you change your mind and the thing starts to fade or whatever, there's several things you can do. One of the things you can do is take a short position in the underlying and create a synthetic put. And what you're doing there with your, so this, if this is your call option, sorry, if this is your call option, you have the stock, well, this will protect you from the downside. When you buy the call option, sorry, when you sell the underlying, you're creating effectively what is essentially a synthetic put. And what I often do myself is, if I change my mind, I buy a call option, I see the thing tank south, I'll short the stock, or I'll short the number of deltas that I've got. So if I've got 50 deltas, I'll short 50 shares, and then I'll actually sell a put or etc. to create what is essentially a short covered put. Not like a short covered call. One of the things I would mention here is we're probably going to get more into the detail, the more developed, complicated strategies at a later stage. When you sell a call option at a lower strike, if the underlying heads south, you can always sell a call option at a lower strike and create a bear call spread, right? So now you're creating defined risk position, creating a bearish position there. Or you could sell a call option at a higher strike to try and recover some of the costs that you paid for that long call position in the first place. Now, oppositely, if the thing goes to the moon, you can actually delta hedge to lock in the gains. And this is particularly useful for out of hours. Now, what I mean by that is if you buy a call position during earnings and the thing just goes, rocket ships through the strike price and goes to the moon, what you can do is you can actually sell shares in the underlying to lock in those profits. So you've got 100 deltas long on the call option because it's deep in the money, because the underlying has gone to the moon. Well, then you can actually sell 100 shares after hours and lock in that profit. Now, that's particularly useful because you can buy and sell shares after hours, but you can't really buy and sell options after hours. So it's a bit of a sneaky way of locking in a profit, particularly if you think that the following day it's going to go to the moon and then tank straight away. Then what you want to do is you want to sell the equivalent number of deltas to lock in that profit, something that I've done before. You could also sell an at-the-money put to create synthetic stock or synthetic equity. It's a bit more of an advanced thing there, so I'll get probably into that at a later stage. Or you could sell a call option at a higher strike to create a bull call spread, and then a deep in-the-money put to create what I call a leverage synthetic, which is even more, well, I would say probably more complicated than the synthetic equity. So looking at the long call gives you flexible directional risk exposure. So you can take on 10 deltas or the equivalent of 10 shares just as easily as you can take on 100 deltas by buying deep in the money call options. It benefits from increases in volatility, right? Remember, so what you want to be looking for on the Chameleon, particularly on the unusual options report, is stocks which have low volatility, which is increasing. You can buy call options in those. The other thing you can do, which I do sometimes, is on earnings, generally a couple of weeks out or even a month out, you'll find that the options start to increase in volatility, right, in Vega. So the other thing you can do is buy an option a couple of weeks out, and then from there on in, use those different strategies, which I described on the last slide, just to lock in profits or to manage the position actively. Now, the other cool thing about a long call is you have that active stop loss, right? So the most you can lose is the price you paid for that call option, which is a bit different from a stop loss, right? Because stop losses aren't guaranteed by brokerage firms, so they can go beyond. If you have a stock which just plummets dramatically, or the stop loss may not kick in, the call option, you're never going to lose more than your outlay for that long call. So what you're going to find is sometimes you'll have a stock which does this, and it kind of goes through your stop loss and you're out, but then after that it goes straight to the moon, right? So, and this is kind of positive for a long call in regards to actually just holding a stop loss on equity, for example, because that long call, it gives you that guaranteed floor that the most or the maximum you can lose. Can be the first, as I mentioned, first leg into an engineered position. This is often what I do. So I see what's happening in the market, I see where we're going in terms of volatility, and I'll just buy a call. And then from there on in, as time moves on, etc., I'll add something to that call, whether it's short equity, whether it's another short, whether it's a short call or whatever, just to build into a position. So normally I will leg or layer into a position rather than go all in. And, it's an ideal risk management tool. So if you have short equity, you shorted the stock and it's going against you, you can use call options to delta hedge to a certain degree, of course. And it's something that you need to follow actively. So that's pretty much it for today. Just want to go over to the Chameleon really quickly because I do want to show you guys some stuff. So often I'll go here. Let me show you. Can you see my Chameleon screen there, guys? I hope so.
Yeah, Jake, while you are walking around the Chameleon, one question popped up from Trevor. And Trevor's, I don't know if you've met him in the Discord, but he's active on the morning live chat. He's asking, can Jake show us on Market Chameleon how he finds calls he may want to trade? Maybe you're doing that now, but that's one.
Yeah, so that's one of the things I'm doing now. So I'll look at this. So Trevor, one of the things I'll do every day is I'll come to the options and I'll look at unusual options volume, right? And a lot of people do this, looking at, where we find, a relatively high degree of option buying, and then trying to determine or trying to figure out, it's really detective work, but trying to figure out, the story behind why that buying is occurring and whether it's it's worthwhile putting on a long call position. So I'll do that. I'll then filter here. I'll click on relative volume, just showing you now. Sorry, my computer's a little slow. Now, once I've filtered here by relative volume, now often you've got a whole heap of stuff in here. So you've got penny stocks, you've got all sorts of things in here. And you really need to do some filtering. The first thing I'm looking at, guys, is I'm looking at this implied volatility range. So I'm not going to be buying long call. Here's a perfect example. I'm not going to be buying long calls on TBLA, despite it having relative traded volume of 47x. I'm not going to be doing it because the calls are so rich in volatility, which means they're priced at a very, very high price. So I'm not going to be buying long into something with high volatility. What I'm going to be looking for is something like this. So I won't automatically just say, hey, look, it's got low IV, so I'm buying it straight away. No, but that's probably one of the first starting steps for me to identify, an option. So here we've got 100% calls on, I don't know this company, PR Pacific Holdings, 13 times. So straight away, I'll then actually go and look into that. So let's have a click on it. I don't guarantee you guys will find anything particularly interesting, but we'll be able to identify. Here we go. So I then will look here, and I'm pretty confident here we've got a spread just by looking at the options volume and maybe some people following in on that. And it looks like we've got an earnings play as well. So we've got earnings on the 24th of February, no dividend or anything like that, low IV as you see, and that IV is growing, right? So it looks like here, this earnings doesn't seem to have been announced, because on the Chameleon, you'll see this asterisk here, which means that it hasn't, it's not cast in stone. It's just a predicted value. But then I'll see here, like straight away, when I look at this, I know that that's a spread. I will click on the details to show you guys how to identify it. But me, just by saying 4,000, 4,000, that's a spread. Whether it's a bear call spread or a bull call spread, not sure. You'd have to look at then the implied volatility change. So here, plus 29 IV at the 17.5 strike, minus 7.4 at the 25 strike. That kind of indicates to me, again, not cast in stone, not definite, but that kind of indicates to me that the long buying's happening at the lower strike and the selling's happening at the higher strike. So what we potentially have here is a bull call spread and a bullish outlook on the stock. If you click on here, then you'll get some additional data. I'm sure you guys are already familiar with this. But then you'll be able to click on here to find the notional. So we've got $128,000 worth of options. So call options, 4,000 being bought at the 32 strike. Look here, the bid-ask spread is pretty wide, and we're hitting the mid, right? So nothing really. Again, we don't have the bloodied knife in the plastic bag here, but we have an idea that option buying is aggressive. It's the mid-range and not at the bid. So that also would suggest to me a certain degree of bullishness. So what I would be doing from there on in afterwards is I wouldn't then open a position. I wouldn't go and buy a call. I would then start looking into this, which is really cool on the Chameleon. I would start looking about the company. So I'd read a little bit about the company to find out, what do they do, which industry they're in, which category, so forth. Have they got anything meaningful in terms of news coming up, M&A, whatever. And then from there, I would go back into stock info. I'm doing all this quite quickly in the interest of time, but I'd also start looking at trading stats just to get an idea of not only, so look at the options, right? 90-day average is 866 contracts. We're trading now at about 12,000. So it's pretty aggressive, I would say, buying. And I'd say just off the bat, this looks like a pretty bullish play for me. And then you've got, stock, the underlying, there's not excessive buying in the underlying either. So it looks kind of like a bull call spread. This stock has had a tough time as well. So, one of the other things I would do before I went and dived into a position, I'd go and have a look at a chart just to have a bit of a visual overview of how that works. And that's pretty much it, really. I think, we've kind of met that, that's kind of me done today. So just to recap with you guys, long calls, directionally bullish, suffering from time decay. Use the option chain and your positioning on the option chain to limit that failure decay or the time decay. If you have a bullish outlook on a position with a holding period of 90 days, buy 120 days worth of time and then sell, with 30 days remaining. And you can use that long call to then create other positions, whether there's a synthetic puts or whatever, bull call spreads or whatever. So really good for legging into positions and also excellent for outstanding options volume. So that's without a further ado, that's me done for today. I'm probably going to, I'm going to relax. So thank you very much.
You deserve it after a long day in that mine, I'll tell you. I mean,
it was a
500
mile drive today. That's true. I was out for 9 hours.
Oh my God. So when you go to the mine, are you actually down in the mine?
No, so this is an open pit. So what you see behind is an open pit gold mine, right? So it's open. Basically, it's drill and blast. So you'll use, like a drill rig you see in the oil and gas industry, you'll drill into a formation, you'll put dynamite down there and you'll blow the whole thing up. Then you'll go through graders and diggers and you'll actually pretty much scoop up what is left. So rocks, essentially, in simplistic terms. You put them into what we call a big crusher, which crushes them up. They go along a long conveyor belt into a mill, what we call a gold room, and they get milled and crushed up, and then that's how you start to develop gold. And so this here, what you see behind me is a gold mine. We also, I haven't worked in any underground mines. This is my second time on a surface mine. The other one I'd done with you guys, I actually followed you guys on the Chameleon. I sent you a photo of a chameleon from Madagascar.
Yeah, I remember
that was a nickel mine. So the big ones, and this is really cool because it also helps me with my appreciation of commodities because I trade commodities in general. And I think the big ones, copper, nickel, cobalt, stuff like that, really interesting. Not so much gold, right? I'm not, I have a gold mine behind me, but I'm not mega bullish on gold for this year. But anyway, one last thing, guys, I'll try and get a bit more active into the Discord. Feel free to hit me up. You can direct message me or whatever. If you want to chat, whatever, no problem. Share experiences. That's what it's all about.
Yeah. So everyone click that link, get over to the Discord. James says, thank you, Jake. Great presentation. Actually, we got another. Trevor said thanks. Super helpful with your analysis of the calls. But then he says at the end, did you find any gold, Jake? How much gold do they pull in per ton, you think? It's got to be super small, right?
Yeah, it's just to give you guys, I know how much it is. It's about 2 grams per ton.
2 grams per ton of rock.
So basically, the really productive, give you a rough idea, the really productive mines will be doing 6 grams, 6, 7, 8 grams per ton of crushed rock. And an average mine, this is a small one behind me, will be doing 1.5.
Amazing. All right, Jake, you always bring it. Thank you so much, my friend. Let me know next time you want to do a first. I guess we rename it to midday call, or we'll keep it at first call.
Well, we go from a broad call, maybe. I don't know. I think I'm going back to Malaysia for 3 weeks in a little while, so maybe we'll do it from Malaysia. Not sure, but I'll be in touch anyway.
All right, awesome, Doctor. Everyone, take that link, go to the Discord, get on the Discord. Be active with the community, It's a great resource that Jake created. Thank you, Jake. Thanks for the great webinar. Everyone, thanks for showing up today. Much appreciated. Have a good last, looks like 25 minutes of trading, and we'll see you tomorrow morning with our live morning show with Dimitri.